Our next presenter is a gentleman by the name of Brian Perillat. He has over 20 years of experience in the field of agricultural economics and market analysis. In 2022, Brian started a new role as an agribusiness specialist at More Than Just Feed, and prior to that, he was the manager at Canfax for 12 years. He has worked with MNP as a farm management consultant, as well as working with Alberta Agriculture, working with them to complete industry economic analysis, as well as compiling benchmarks for cattle producers that they can use in their decision-making processes. Brian himself grew up on a mixed farming operation near Duck Lake, Saskatchewan. He continues to be involved in that family farm and takes great pride in being part directly of the agriculture industry. I'll get you to give him a round of applause and welcome him up here.
Thank you. Right on. Good afternoon. Yeah, sure. I'll get going. Okay, everybody can hear me all right? Hopefully I got a bright light in my eyes. Yeah, certainly a pleasure to be here. I know it's kind of nice these days. I've been doing this a little while, and it's not always, well, probably never been this optimistic as we've got record high prices hitting the industry and for calves and all types of cattle in North America right now. So, sorry, I put that down. So yeah, I'm happy to be here. It's great to follow up a risk management presentation for sure, because as we talk about these kind of price levels, everybody's risk is elevated. And you know, we certainly do. I do a little bit of work with specifically on risk management strategies. Some can be a little bit more technical around hedging and looking at futures and dollar. But we do have some pretty handy tools right here with our price insurance program and certainly agri-stability. You know, as a simple, general, larger farm level kind of insurance, basically, and some risk management. We certainly use it, or I use it for my operation, and it has paid off when some things, they don't always go your way. Absolutely. So, with that, I guess I can't see too well, but if you've got questions as we go, I don't mind getting paused and shout something out so we can cover that off as we're going through, or we can do them at the end. But I'll just jump right into it. Cattle markets, cattle data. I'm going to give a little bit about what's going on in the cattle market right now, what's driving some of this, and maybe a little bit of an outlook and things to consider. And I also want to get into some data. You know, one thing about cattle markets, they go up and down. There's a lot of things you don't control around that. You can control how you react to the markets. That's part of risk management and strategies. But on the data side, as we look into managing our cattle herds, cow-calf, I also do some benchmarking work and helping guys be more profitable, because we definitely want to set ourselves up for success. We know the cattle markets go up and down. So how do we invest and create an operation that's going to be profitable longer term and set us up better when we do have some leaner years so we can remain profitable and as we go forward. So as we all know, I'm sure everybody's well aware of what the cattle price chart looks like right now. Certainly, you know, these cattle prices have been interesting, that we kind of had a bottom in September all through fall run. You know, we just saw prices go higher and higher. And, you know, now we've got 600-pound steers trading for about $5, 800-plus pound steers at $4. You know, this phenomenal prices. There's a lot of optimism out there, but you always got to be aware the markets like to price in optimism ahead of time, which is maybe, you know, not to say these markets can't go a little bit higher, but at some point those calf prices get so high and everybody gets over optimistic and overpays for calves. And then when they come down, it hits a little bit harder, because you're now dropping from $5 and $6 calves versus $1.50, $2. Doesn't seem, we weren't too long ago, we were $2 calves here 3-4 years ago. So yeah, we've got, there's two parts to this, and I'll get into what's driving some of this. We got to remember, I'm going to talk a lot about the United States, which, you know, is a little more interesting these days with Mr. Trump down south, and I have no answers on what the tariffs, when they're going to be and how much they're going to be, so sorry I can't answer that, and make some calls, but yeah, nobody's got insight. We're all speculating on what that means, but I think overall the messages, we have to be prepared for some sort of tariffs in Canada. What that looks like, we don't know yet, but definitely is adding another level of risk. So we talk about price insurance. as a tool. It's a Canadian tool. So if our prices go down, we're protected here. A lot of other tools use the futures markets. That's US based, so we might not have as much protection around that right now. But the reason this is really important, the US drives the marketing bus. They have about 10 times as many cattle as Canada, or 10 times as many cows. They got about 29-ish, 28, 29 million cows. We're just over 3. So 8 to 10 times more cows. They almost have about 10 times as many dairy cows. And if we have open borders, we both produce, grain-fed AAA or choice beef, pretty interchangeable product. What they do definitely impacts us directly. The caveat being our Canadian dollar comes into play. Canadian dollar has been pretty helpful to our price system too. So keep in mind how the U.S. is really the big driver here. And if we look at what's so bullish around some of these, this chart's showing you the blue line is U.S. cattle inventories. The red line is production. So we've been dropping cattle numbers. The U.S. now is the smallest cattle herd since the 60s, about 1960 or 1962. The smallest herd last year, and we were not far off record beef production. So we were producing a lot more beef from some of the smallest herds in 60 years. So we're doing a good job growing more calves. We're weaning more calves per cow. Bigger, much bigger. Actually, last week the U.S. set another record for carcass weights. The average steer in the United States last week was 962 pounds. So that's the average of all the steers that are killed. We're not far off of that. We're a little bit leaner right now, but we are also growing our steers bigger. So that's one way to grow more beef from less cattle. But if you see the red line, how much it is expected or is coming off of there, that's what's setting up from the producer level. We got less cattle, less beef around. Certainly that's setting up a bullish situation where we're seeing prices quite strong, or we're pricing in very, very high prices because these calves really don't come to market for 6, 8 months, maybe a year, some of these smaller calves. So they are already anticipating or need higher prices to make money. So if you're buying these cattle, there's a lot more risk in the game. But remember, as we look at those, that's a pretty major shift in production. Look at 2014, 2015. Here, we saw that same kind of decline. We all knew what beef production did. But it's a little bit different this time. The next chart kind of shows you that the red line is still the same. That is your beef production in the United States. So we see the drop-off here. Oops. You see the red line drop off on the left, on the right-hand side. But look at the blue bars. That is beef supplies. So production doesn't really equal supplies. Look at 2014. Look how much beef we had in the United States compared to today. We've got, a couple billion pounds, over 2 billion more pounds of beef in the United States today than we did in 2014. So one of the stories that we really get to the point is beef demand has been phenomenal. Absolutely phenomenal, because really we have yet to see tight beef production. We may not see as low as 2014. The way that does that is the U.S. has become a major importer. Our prices are so high. We're seeing beef come in from Australia and New Zealand in a big way. Even Brazilian beef into the United States, they're paying a 25% tariff already, talking as tariffs, and it's still, or it might even be more than that. They're paying a large tariff, and they're still getting their beef into the United States just because the prices are so high. So we still have a fair bit of beef around in the United States. So really a lot of this optimism or prices we're seeing today is beef demand, and we're seeing those dollars get down to the producers because the packing plants, there's just not as many cattle around. So they are bidding more aggressively. So a combination of demand and getting those dollars to the primary producer. Cattle on feed, same kind of story. We've still got a lot of cattle on feed. January 1st is going to look pretty similar. We still have about as many cattle on feed as we did a year ago. Again, look at 2014, that big drop. We've got 1 million more cattle on feed today than we did 10 years ago, the last time we were this tight. So that's, as I said, we're going to probably bring in a lot of beef, but on the optimistic side, tight numbers are going to get tighter. The U.S. cattle herd peaked in 2019. We've shrunk every year since. Probably going to be a little shorter, smaller on January 1st of this year. We'll have that report. I think it comes out on the 31st here, so it'll be in about 10 days or less than 10 days. We'll have a U.S. inventory report to compare to. But we have still not seen the really tight beef cattle supplies. But again, the market's already anticipating that, so we got to be aware of how much higher we can go. Herd rebuilding is the big one. That's the crunch when we have a small cow herd, a small calf crop in 2025, and then we start retaining heifers out of that herd. That's when we see that kind of crunch in cattle numbers. This is just showing we'll have an updated number for December 1st, but we're still putting a lot of the heifers on feed in the United States. The weather just has not been conducive. The market prices are there, but in 2014, you see that massive drop. That was the year that the market went pretty wild because it was such a large and fast drop. They got all of that rain in those prices, and they kept heifers and quit slaughtering cows. We haven't seen any of that. So you also got to remember 2014, 15, really, that's our best comparison. 2016 wasn't a lot of fun. After that, this just shot prices through the roof. And then once that was done, we started to rebuild the herd. Prices quite quickly dropped. As we'd seen, we knew we were having more cows down the line. It doesn't look to be the case this time. So, that 2016 crash was a bit of an anomaly in terms of how fast that market went down. At this point, we're not anticipating that kind of drop off. Again, we got political risk and some demand risk out there, but that was extreme too that year. So we definitely got to watch. So as I was talking about beef demand, this is looking at, so one thing is supplies is still not the whole picture. You've got to look at per capita supplies. The population's grown some. Here is 2014, and this isn't adjusted for inflation. This is the wholesale beef price. So in 2014, there's our per capita beef consumption, how many pounds. And we are now looking at these kind of beef and meat prices today. So we've got way more meat, and our prices are still, even after you adjust for inflation, are still slightly higher. But we're consuming way more pounds of meat, of beef in the United States. So record high prices and much higher consumption is very, very, very good demand. And that's a big part of these prices. We haven't seen the whole supply story. And this is just showing where retail prices are. They've crept back again. We just got some updated data. They've started to creep back up again. So don't forget that. I think I was here 2 years ago and we were talking about Beyond Meat. Well, we kind of kicked Beyond Meat's ass, which was kind of a good story for us. So they didn't last long, and the true meat demand has shone through. But it is a bit of a risk. We have a lot of competing meat. This is pork consumption, poultry consumption, just continues to grow through the roof in the United States. So again, trade, tariffs, Trump and his trade stuff. Gee, they ship a pile of pork to Mexico. He wants to get into a trade war with Mexico. Well, there's certainly some concerns around this, not just directly to Canada. Could cause us a lot of risk here in the meat market. And the other thing, as I was talking about demand, there's only so far we can stretch consumer dollars. We consume so much ground beef. About half the beef we get consumed in the United States is ground beef. So one of the ways is we grow these animals bigger. There's a lot of ground beef. A lot of the meat from these finished steers is also getting ground up. But we also like to look at, and as we go through recessions, hopefully they're looking at the restaurant indexes and such in the U.S. do look to be improving here. But we have stretched in terms of what the price of ground beef is relative to chicken breast. We have been growing it over time, but it's certainly getting rather stretched and rather relative to pork loin. If you go into a grocery store, you can buy a heck of a lot of pork loin for the same price as a pack of steaks. So it's something we have to be aware of. Where it stops or how far we go, it's hard to say, but this just adds to the risk level when we get to these kind of prices and we start talking about any kind of trade disruptions. Herd expand, so in Canada, the same old story. Been doing this about 20 years and selling the whole story. We're not growing, we're shrinking. We're not shrinking too much here, but we get a really good year in Canada is when we don't shrink. It's not about growth. The U.S. added about 2 to 3 million cows in their last expansion phase. We just kind of paused our reduction and then continued to drop. We are looking a little bit more positive this year. We've certainly had in Western Canada a lot better moisture, a lot more hay around. Our farms in Saskatchewan, we sell quite a bit of hay, and it's usually we've been chasing hay buyers away, and we've actually got hay left to sell. First time in probably 5-6 years. So it's certainly changed, and that's a big driver around cattle producers' decisions on whether they keep or sell cows. And we did see our cull rate drop from the Canfax data. They put out, our cull rate has dropped a fair bit. The challenge is we have not kept many heifers back either. So are we going to stabilize? We're probably maybe stabilizing at best. We have to see if we actually get another year of actually keeping back heifers, which gets tougher when we've got 1,000-pound, 950,000-pound heifers for the fall selling at $330. We talk about how crazy the bread price is. Well, a cull heifer's worth $3,300. So that's kind of a double-edged sword on growing the herd in these kind of price levels. Speaking cull cows, they continue to do well. They are very seasonal. Cull cows are probably the most seasonal market. They come down in the fall and then start to pick up a little bit late in the year, and then January all the way through the summer they go up, and we're starting a very same level. Rail cows around that 350, 345, 350, maybe 360 on the rail for cull cow prices. A lot of cows get grain fed now these days, but that also helps your cull cow market through the ring if you're not selling direct to packers. There's a lot more than just packer buyers these days at an auction mart buying cows. But yeah, assuming, we looked, our cow numbers through auction marts are pretty tight. There's a lot of cows in feedlots right now. We're just waiting on the Trump tariff. Some guys are just selling cows just because they're worried. February 1st was thrown out there just yesterday. So it looked, otherwise than that, the cow market should be pretty seasonal. As I mentioned about demand, exports too, it's not just about domestic demand. Our exports continue to be huge. You can see the blue bars volumes. Volumes have somewhat leveled off, just we're not producing. Our growth in beef production has slowed down, but the value of our exports is phenomenal. We saw for about 7-8 years, we saw volumes go up and values go up, and values went up faster than volume. So that means we were selling more on the export market at higher prices. Over $5 billion of exports the last 2 years. This year, we are down slightly in volume, and just slightly in volume and just slightly in value. So, realistically, this line will kind of flatten here. But we're still seeing very, very good export demand. Here's one of the more interesting slides if you think about it. If I just skip back, sorry, I got to go too many. But this is our cow number. This is the number of cattle in Canada. So what do you think our processing's done? It's kind of quite the opposite. We've actually expanded, 2014-15 when prices were good and cattle numbers were tight. We expanded faster than the United States in our supply level of beef in Canada. We increased almost 30-some%, like 32% from the 2015 low to the 2022 high. We expanded significantly. We built feedlots mostly in southern Alberta, maybe a little bit in Ontario. We added that packing. Balzac meats came on, or Harmony beef came on, sorry. So, we've added some packing capacity, and the big packers were running 6 days a week, and we put a lot more cattle through our processing plants. They mainly stopped killing Saturdays because there's just not the cattle around, so we are seeing some cattle shrink a bit, or our throughput shrink, but we are exporting quite a bit still to the United States. So you think about that. How did our herd continue to slide for 10 years and our production went up 30-some% through our packing plants? And the way we did that was our trade. Canada's always been a net exporter. We still are a net exporter of cattle, but we are now a pretty major net importer of feeder cattle. A lot more cattle like feeder and calves. We used to ship 500,600,000 on a really big year of feeders to the United States. Now we're, just over 100,000 feeders go south. We still export, the 500,000 of fad cattle, and we still export some cows. But we're a net exporter of cattle, but a net importer of feeders. And this year's been huge. Look at last month, and the last Stats Canada was showing 70,000 imported feeders came in I think that was October. Big numbers of feeders coming north. And so this is thousands per month. And then this is thousands. So these are not actually on the same values. So, we were only exporting like 10,000 head, bringing in 70. So we've been a net importer of 234,000 feeders this year. Last year, we were only a net importer of 150. So it's kind of interesting, bit of a head scratcher. We have corn coming north. We got cattle coming north. But our feedlot sector mostly, as I said, in Alberta specifically, growing some large feedlots. Good demand. And in Manitoba, you're quite well positioned in terms, you've got very good demand in Ontario. Their cow herd has shrunk. Their feedlot capacity hasn't really changed too much. So good demand there. Got west and potentially also a U.S. market. So there's certainly times where in Manitoba, you're enjoying some of the strongest feeder prices in Canada, as we've got excess feedlot capacity for our cow herd. I always get this question, and I'm not sure if people are aware just how many beef on dairy cattle there are. The dairy industry, and it kind of makes sense. We may not like it too much, not the story we want to hear, but realistically, their cattle, they can produce beef, and they've always been part of the beef chain. We can't forget that. But a lot of these dairy farms use sex semen, so they breed their best cows to get the heifers that they want, and the rest that they're milking, that they'll breed them to a beef breed. So that's really increased. A lot of these imports coming north are beef on dairy calves. So you got to remember, there's 10 million dairy cows in North America versus 31 million beef cows. So it's a big number, and most of the time they've been there, but it has shifted around a little bit. A lot of these feedlots, one of the ways we've grown our feedlot capacity, some of these calves come up here. Feedlot's like a hotel. They want to be full all day, every night, right? So one of the ways some of these dairy calves come in and they fill that pen up, or pens, or a feedlot up for 365 days. You only have to, book somebody in once and they're there all year. That's pretty handy for the feedlot. They're easy to put on feed. They're already trained for going to bunks and eating dry feed, so that works out well. They're still figuring things out there too. They're going to continue to advance and compete a little bit as they get better bloodlines and genetics on, they figure out, so different breeds. Some guys are very heavy into the Angus, but there's Simmental, Charolais. Different bulls work differently with the dairy side. So a lot more to improve their efficiency, but they're going to still be around. But we got to remember, there's only so many dairy cows. It's not like we're going to suddenly making them all have twins or anything. It's just that they're getting more directly into the beef plant chain. The interesting thing of this is that there was dairy calves in the United States last year, $800 for a baby calf. They were almost just a byproduct of the dairy herd. So the large dairy producers, their margins weren't that great last year or 2 years ago. So they loved that new revenue stream. So they were breeding cows aggressively. So they've actually probably overdone it to the point that they're now short of dairy replacement heifers. So as we talk about cow numbers, beef cow numbers, they're going to tighten up, and the calf crop's going to be smaller. There's probably going to be a few less of these beef on dairy calves because the margins on the dairy side have improved dramatically. So they've got good margins, and so their dairy heifer replacement prices have gone up. So they're probably going to see a few more dairy cows get bred dairy. So all at the same time as we see these tighter numbers. We look at the chart, this is out of Cattle Facts of the U.S., but they have added some numbers, maybe 500,000 or so calves more, a little over 500,000, but we're going to be down. I guess if you go back from 2020 to the old to here, 3.5 to 4 million, but we're probably even going to come down 100 to 200,000 head. Well, we've come down some already, but could tighten a little bit more. Oh, sorry, that is out to 2026. So as you can see, we are going to see less. That is anticipated. They're going to need more dairy calves to keep in their herd. As I mentioned before, making them bigger, how we're producing more beef, we're going to continue to do that. A lot of these cattle, one of the ways these feedlots, they want to keep their hotel full. They go look at the price of calves, and they go look at what they got, and they're like, well, I'm just going to feed these ones longer. It's better, probably more economical to do that for them. So it's, it's just what they're doing to grow their cattle, to grow our beef production and keep the feedlot going. Feed grains, so when we talk about those calf prices, we've had a bit of the perfect storm and the anticipation of it. Realistically, we've got tight cattle numbers or anticipating tight cattle numbers when these calves go to market. You have less calves coming around. Grain prices have dropped dramatically from where they were 2 or 3 years ago. That's huge. And demand. Just absolutely great demand out there. So we've got all of this going for us, and the Canadian dollar's tanked. So, those 4 factors have all multiplied as to why we're, you can go to the auction mart and you'll probably see something sell for over $6 a pound, all because of, everything's gone our way. So we got to remember, grain prices kind of creeping up. They did cut the U.S. corn crop. We rely a lot on imported corn. Now we bring into southern Alberta, there's some big rail line companies. They bring in corn year-round. They've never done that before, till last year or 2 years ago in the drought, and they've just continued to do that. That's how we can build these feedlots. But as the corn prices start to turn and our dollar stays low, they're losing a little bit of an edge on that feed cost. As I said, that Canadian dollar been very, very weak. I'll talk about what those impacts are, but this 69 cent kind of range is kind of a critical point. We've been there before and sort of bounced back or touched it just under 69. I don't know, a lot of political uncertainty here to watch. The U.S. dollar's kind of tumbled a little bit, so our dollar has jumped up 3/4 of a cent in the last few days. So we have to watch that. But if we go below 68 cents, there's, not to say we're not back to that 66 cent level on a chart. There's not a lot of support in that area for the dollar. But not sure if we break through. If the dollar does start to creep up, politics between Canada and the U.S., that could also take a bite. And I'll touch a bit on that yet, what that could mean to prices. The other thing I haven't really talked about yet is basis levels. So the one thing, we talk about futures and the dollar, but our prices, we track and trend the same as the U.S., but there's always this difference in terms of our basis. Sometimes there's been times where the basis is kind of the difference between Canada and the U.S. market after we adjust for the dollar. So, our prices are, what are we, 260, fat cattle prices 270, and the U.S. is 202. But again, that's 270 or 260 Canadian and 202 U.S. If we look at those, we sound a lot higher, but on our fat market, if you convert that 202 to Canadian dollars, we're still at a huge discount, 25 cents a pound. That's $25 a hundredweight. So we're still seeing a big, big discount to the U.S. market. And again, throw in, this is before we even have the tariffs or any political risk here, trade war risk. So, and that, there's times we go positive, and often very, very seasonally in the last few years, in about May, June, we'll go premium to the U.S. market. That's our tightness when we run out of yearlings and our calves are kind of not quite ready in big volumes and demand is high, we go to a premium to the U.S. But right now we're already at pretty tough basis levels, and we don't even have a tariff on yet. So some concern there. The feeder cattle, we continue to remain strong in terms of our feeder. As I said, we import feeders, so our feeders are well supported. I must also say this is on a cash basis. Most of these feedlots do have them contracted. You can get contracts that are only a -2 or 3 sometimes, or 0, might even be a positive. So this is only a smaller percentage of the cattle that have that basis level, but the guys, if you don't have risk protection on, that becomes extreme, because $20 basis shift from here, that's over $300 on a steer, on a fat steer. If you're thinking, we'll be close to par to the U.S., and you're all of a sudden $20 below, there's $300 less on your cattle. The futures, here's one, I don't know how many people here follow the cattle futures, but that's certainly always my message. We have tools out there. It's my cheat sheet of what do I think the market's going to do. I always take the futures and adjust for the dollar and guess or estimate or go find a basis level to project prices. And this is just traded in the CME, the Chicago Mercantile Exchange, and it's a U.S. contract. We roughly compare it to 850-pound steers here. Some may say it doesn't matter. It's just people trading on their computers. Well, yes, But here's our calf price chart. This is the one I started with. Kind of looks the same, don't you think? So, like it or not, those futures are huge drivers. And you can go check the futures for 2026 now. They're pretty strong, but they're not a lot higher than they are today. Not to say they're always right, but they certainly have seen some leveling off of these prices on the futures, which is rather interesting. As I said, we're pricing in a lot of optimism, as always. So just because prices are good and calves are expensive and optimism's high, doesn't mean these calves you're buying, if you're feeding cattle, are going to make you any money. Optimism isn't a hedge strategy, that's for sure. So projecting price is just a simple math, because the reason I do this is, and again, it sucks we're talking about a political or trade war issue, but let's say it's something happens in the world, or there's some news breaks or whatever. I can do this presentation and it can all change tomorrow, and we're certainly at risk of this changing at any time. But usually if there's a free and open border, if something changes and there's a demand spike or an issue. The Mexican right now, they've got that screw worm in the Mexico, so the U.S. shut their border. They bring in over 1 million Mexican feeder cattle into the U.S. every year. They're not importing Mexican feeder cattle right now. That's supporting our market. So what if that changes? What if they open that market up? They're anticipating to open that back up again. Futures are going to probably go down. So you can just go check the futures and do the math on. And if you do use price insurance, this is pretty much the methodology that price insurance uses as well. So you take the feeder futures, Canadian dollar, and you need a basis. Canfax that's where I used to work and still definitely promote all the information they have. I use it a lot still. So if you take the feeder futures, it's 267. It had a huge day yesterday, so these are even already old. The dollar at 69.9, and I used a basis of -5. That's kind of roughly historical, not far from where we are today. So you just take the futures and divide it by the dollar, and you -5 from that. So 267 divided by 0.699, that's kind of where the dollar is about 282, I believe. And then you take off 5, you end up with about a 377. So March feeder cattle are trading right now in those low 380s. So there was some trading there. So that's just kind of the math, so you don't really need a market update every day to figure out, or every time there's kind of a news story or a market shift on what that could mean to your projected prices. Or the dollar shoots to 72 cents, or it goes to 66. That'll have a pretty big impact on that number. And as I said earlier, there's some 950,000 pound grass steers trading for the 360. So this is for an 850 weight steer, that 380. And this fall we've got, again, 950,000 pound steers. $3,600. So what does this all mean? Well, one of the other things I kind of do now with Bullseye and helping, when I'm sitting down, I do some of these projections. One of the things I was going to say for risk management, if you buy cattle and feed cattle, one of the most important things I like to stress and get involved with, guys, is buy and feed cattle that have the best probability of making money. Because there's a lot of risk out there, and you can buy calves, and we do the math and try to contract them, or you're going to lose $200. You need the market to go up. There's a lot of cattle today selling really high, and if the market doesn't go up $100, they're going to lose money. Not to say it won't, but they're gambling on that. Some of them you might run will be $250. There'll be other ones. You know what? You buy these lightweight heifers, they're only $50 offside, or whatever it is. So let's start with those ones and then build a risk management plan, not go buy the ones that are $250 offside because you like feeding 750 pound steers, for example. So that aside, I guess that's a little off. But the other thing I do is when we look at different categories and types of cattle, if you're planning, your feed conversions, it's something you should be measuring when you're feeding cattle to decide what to buy. So if you're going to buy a steer, and this is based off a feedlot finishing cattle, they're going to buy a steer, they've got the ration cost set, and they know, here's what my ration I'm going to feed, and I think these steers should convert at 6.75 to 1. Well, they end up only converting at 7.1. They just don't have the performance in them, and we're not going to blame weather or anything. This is strictly, let's say these penna calves you misjudged and they don't perform as well. Well, that guy might have said, you know what, I'm going to project a $50 profit, or when I can get a $50 profit, I'll lock that in. So they do on the price side, but at the end of the day, they don't convert it well. All of a sudden, that $50 profit is gone if the cattle only converted 7-1. That makes sense. They didn't convert. They're not as good a cattle as they thought. On the other hand, let's say if they had a $50 head profit locked in, those cattle perform really good. They get a 6.5 feed conversion. So if every takes 6.5 pounds of feed to get 1 pound of live weight, they've now made $100, or they've done better job on the nutrition plan to get better conversions. So that's why. So that's one example of. So if you buy second cut cattle that are only back 10 cents a pound, or let's say they're only 7 cents a pound, he's 500 pounds, I bought him for $35 less. Yeah, but you bought him for $35 less, but he converts a quarter of a point worse. You're now even $15 more in the hole kind of thing. So how do you price cattle? It comes into the steer heifer spread, which I'm going to talk about, always a good topic for discussion. Dressing percentages, same kind of thing. When we've got cattle that are selling on the rail for $4.50 a pound, if your cattle only dress at 59.5% instead of 60%, that's a lot of money. It's $25 a head just on that dressing percentage. And then the other one is around death, loss, and health. There's been wide variation. Some feedlots really struggling with health, as producers doing everything they can from vaccinations and minerals and all of that throughout the production system. If they're not performing at the feedlot, or you can produce calves, a pen of calves where your health is much better, and you can drop your death loss by 1%. If the feedlot's normally at 2% and your pen only have a 1% death loss, your calves are worth $25 a head more. So you take 202 600-pound steers side by side. If you go to an auction mart and like 6-weight steers, there's a very wide variance on these cattle. Well, these are not big changes. Those slight tweaks in feed conversion, they're going to dress out better. So 80, and then a death loss and a healthier. There's $100. It's nothing to get $120, but you get a bit better feed conversion, as I said, and better health. You got a $120 difference between two 600-pound steers. That's 20 cents a pound. So understanding and knowing that that's why maybe they're valuing or trying to find those cattle that perform well in a good health program is huge. The other one I was going to talk about is the market side. I talked about the Canadian dollar shooting up or dropping, that kind of thing. With these, where the futures as high as they are and the U.S. market as high as it is, the Canadian dollar even has a bigger impact. If U.S. fats are $1 a pound and our dollar moves a cent, not too big of a deal. But the U.S. market's now $2 a pound for fed cattle. Because that's what a feedlot does. When they're buying your calves, they're going to say, well, what do I think? They're not going to go out and fill a 10,000 head feedlot of calves and without risk management. They know and have a agreement or contract. They know what they can sell them for as fat cattle, and they work it backwards as to what they can pay for calves. And then they usually have to pay a little more to get them bought. But when they do that math, similar to how I showed the projected feeder price, when the dollar now moves a cent, so if the dollar drops a cent, and we've seen our Canadian dollar come down, it went from about 74 cents to 69 cents. It's come down 5 cents, 4 to 5 cents. For every 1 cent move in the dollar, for a 550-pound steer, a feedlot can now pay 8 cents more. So we talk about that dollar going from 74 cents to 69 cents at the peak. That's 40 cents a pound. So why are prices so high? This is kind of some of our answers as to why prices are as high as they are. 40 cents a pound on the dollar. Call it maybe 30 cents today from where we were a couple of years ago. The live cattle futures, every time they go up $1, and they've rallied $15 here in no time. Every time the futures go up $1, they can pay 3 cents more for calves. So again, if the futures have just gone up $15, there's 45 cents a pound. So between the dollar and the futures, there's 85 cents a pound higher for these 5-weight calves just from the dollar and the futures, and then throw in the grain. Huge. Barley prices, if they go up $1, obviously calf prices are going to go down. If grain goes down, calf prices go up. So holding all other things constant. That's for each of these examples. We're saying nothing else changes, just $1 drops. If barley prices go down $1, every time the barley goes down $1, the feedlot can now pay 20 cents more for a calf per pound. 20 cents more per pound, sorry. So we saw barley in Lethbridge go from about $6 to almost $9 to almost $6, drop $3. So that move in barley, 60 cents a pound. So in the Canadian market, I guess the futures are factored into that. That's helped us out. But there's way over $1 a pound just on our dollar, and our dollar and feed costs is about $1. The overall cattle markets has added significantly on top of that. But those two factors alone have made a big difference to our calf prices. So what way's the dollar going? If it continues to go down, it's good for our prices. But if it does start to creep up, you got to start taking 8 cents off a pound a little bit. The other one that's gone the other way is interest costs. If you're feeding cattle, the interest cost alone on some of these feeder cattle, even though interest rates have come down, this number's come down a little bit. It was over 60 cents when the interest rates were at their peak. But the prices of cattle going up and interest rates still higher than they were a couple of years ago. Sometimes interest cost alone is 50 cents a day, so don't forget about that. And if you're only backgrounding some of these calves for 2 pounds a gain, we talk about cost of gain, and guys are, I can do it for $1 or I can do it for $1.20. I'm like, have you counted in your death loss? Because death loss can be $50 a head, and your interest cost can be easily $50 a head. So there's $100, and if you're only putting on 300 pounds, 400 pounds, there's another 20, 30 plus cents you're missing there. So just keeping those in mind. Here's always an interesting topic. It almost always comes up. Why are heifers discounted, or people are stealing our heifers? Well, I can pretty confidently, I buy cattle, and it's pretty confident there's not always, the heifers aren't the good buy. Sometimes the worst, I think people get mad at me, is I say, well, actually, sometimes you got to discount heifers more. Maybe not the case today, but it's certainly, what drives that. Because the other thing we always hear, they sell steers and heifers for the same price. They sell them on the rail. They're $3.50 a pound, or $4.40 a pound on the rail for steers, and they're $4.40 a pound on the rail for heifers. Sure, that is true. But getting them on the rail and how many pounds are on the rail really drive that. So here we go. I'm going to just, the higher the price of cattle goes, the bigger the spread. And the reality is you can grow steers really, really big. You can grow heifers big, but you can expand the weight and size of your steers faster than you can on heifers. So when you actually go to sell a steer, and this isn't even anything too extreme. There's guys cranking out 1,700-pound steers. They might have some 1,500-pound heifers. But in this scenario, I've gotten this. I'm using a 550-pound calf, and I'm going to say they're both $4.75 a pound, probably a little low now again already, but we're going to take the steer up to 1,500 pounds, and that same kind of heifer counterpart she's done at 1,400. It's still a pretty sizable heifer. So you take that size of an animal, sorry, where am I? And you got to remember the steers, as I talked about earlier, dressing percent. You get more, they yield higher or dress out higher. Steer does versus a heifer usually. I use the benchmark 60. There can be lots of variation around that. And I use 59.5 for heifers. So now you got a bigger steer, and he dresses out better. He is worth, in this scenario, in this market, that needs to be updated. But it's the same kind of scenario. We're at almost $4,000 for a fat steer. They would be $4,000 today. This same heifer is $3,500, $3,600. So although you're selling them both for the same price, the same math goes into it, but because of that dressing percentage, that heifer's now worth less. And she's going to be worth a good $400 less when they go to market. And in addition to that, so there's 400 on a 500 pounds, on a 550-pound animal, 400, that's 80 cents a pound. Now, you don't have to get the heifer as big, so you save a little bit there. But on the other hand, feeding heifers don't convert as well. They're a good 10% behind. Their cost to gain is usually about 10% higher than a steer. So they not only bring way less value, their cost of gain's higher. So if you do all of the math on here, in this scenario, the steer heifer spread works out to about 62 pounds, or 62 cents a pound. Might even be a touch higher today with these prices are changing so fast. So, honestly, we're well north of 60. And where are we today? There's some that are. There are times that heifers are buys, but it's not a guarantee. If you don't know feed conversion, if you're feeding heifers or you feed heifers because they're cheap, if you don't know your feed conversion, it's hard to say if it's worth. Sometimes it's still worth selling the heifers and feeding the steers. So yeah, we're looking at 60. Any questions on that? It's probably got anybody? I got something wrong. I must have said something wrong so far. Somebody disagrees with. If not, I got a little bit of slides on data. What did I do with my phone? How am I doing for time? You might have told me I had 5 minutes, but I wasn't looking at you at all. So I got a little bit on the data side, as I talked about, a little bit about market information. What I was just talking about in terms of, this kind of knowing feed conversions, outweights, average daily gains, these kind of rules of thumb in terms of how your animals perform. To me, that is a huge part of data, an opportunity for cattle producers to produce the calves that are going to perform, because you should start to get paid for it more and more as these prices are higher. So if not, that's kind of the marketing side. A little bit on the data side that we're doing. I started a program with Bullseye a couple of years. We're into year 3 on creating some benchmarks. So I'm going to flip around, sorry. If we talk about the feedlot sector and we talk about average daily feed conversion, average daily gain, outweights, death loss, we have good benchmarks for that. If I talk to cow-calf guys, what's your average daily gain on your steer calves? Most guys won't know. They'll know their weaning weights. But is your calf 220 days old or 170 days old when you're weaning? What's your average daily gain and other herd performance indicators? So I've tried to bring some of that into the cow-calf sector. So we did a group of our producers. We put about 65 guys. They have about 30,000 cows in this database around herd production. So here's our I can't see the green very good, but benchmark our beef lytics number. So our average herd size was 416 cows in this group. Open rates. Most guys know open rates on their cows and heifers. Depends on the breeding season. You can cheat that. If you leave your bull out, you will get more cows bred. But is that efficient or not? It's up for discussion. But, open rates, we talk about cows calving the first 2 cycles. Again, tighter calving seasons. You may have to select a little harder for your heifers and cows. But at these prices too, a calf born in the first cycle is worth, has certainly got those extra pounds versus the 4th cycle or later, 3rd or 4th cycle. And then, ultimately a couple things. Weaning weight, average daily gain on steers, 2.67 in our set. And a big number, weaning percentage. We run these cows out, we put bulls out with them. How many cows are you breeding actually bringing home a calf the next year? And that's all over the map from 70% to 90%. Seen a huge variation around there. So what's going on there? Cull cows are worth lots of money, but so are these heifers we got to retain to replace them. So having a bit of a handle around that, because ultimately when we're breeding cows, you got this pounds weaned per cow exposed. How many pounds, if you do all of that work to run that cow all year long, or those cows and heifers, how many pounds are you weaning? So we're trying to just put some, it's a little, keep it as simple as we can, but get as much data out of it. We look at weaning percentages. Interesting. So I took the top third of the guys that are weaning the most. So the 22 top weaning percentages, they were weaning about 88% of their cows. 88% of the cows that they exposed weaned a calf. Interestingly enough, they had almost identical production levels. They were almost weaning the exact same weight a calf, same age, same average daily gain. I ran that to 3 decimal points to make sure it was correct. So these are almost all identical, but just because they're weaning higher, they're weaning 500 pounds per cow exposed. Small little tweaks. They have a little bit better open rate. They are longer breeding seasons, but monitoring that. There's a 50 pounds they're getting more per cow exposed. And then I also did the top third pounds weaned. So the 22 guys that had the best pounds weaned, they had a kind of the combination of everything. They did have they weaned old calves, big calves, and they also weaned 86% of their cows that they exposed, weaned a calf, and they had 560 pounds. So they had 100 pounds more per cow exposed that they were weaning. So we've just kind of created this kind of a benchmarking thing, and it helps us to track. So one thing is, how are you doing compared to others? But hugely, the values, how are you doing over time? Are you improving? Where's your opportunities? That sort of thing. And with these kind of market prices, if we can increase your average daily gain like a 0.1 a pound, you implant, or do you have better genetics, better feeding programs or health programs, there's $40 a head just on that. Well, probably pretty minor changes. Weaning, calves calving in the first cycle, bumping that up 5%. There's $13. Improved weaning rate, just 1%. There's a lot of herds out there that could probably increase that 5%. You increase it 1%, there's about $30 a head. And you can do all of these at once. It's not like if you're giving up. Quite often, if you get more fertility, more calves in the first cycle, you're actually probably going to wean a higher percentage too. Better fertility. So, again, you can quickly pick up $100 per cow by just some small tweaks to your animal performance. So on the cow-calf side, I presume, a lot of you guys are, it's just some starting point. Doesn't necessarily say who's making the most money, but why not get more out of your cows? One of the big things I did look at was, as you get more data, you can slice and dice early calving, late calving, small operations, big operations. One real interesting one is looking at guys who turn out the bulls in kind of winter calving, so turn the bulls out before May 15th, and guys who calve in the summer, so they're only turning the bulls out in July. So the early winter calving guys got the bigger cows, but it's amazing. The open rates on cows almost identical, whether you're breeding in the summer or early in the spring. Age at weaning, so these early calving guys, their calves are a lot older when they wean. But the average daily gain was huge too. Those calves are out eating some of that nice grass, where these calves are just getting born onto it, and by the time they need a higher milk and lactations, the grass has already gone down. But still within those groups, there are guys achieving some pretty good average daily gains, even on summer calving programs. And it's not about age either. I ran some scenarios of looking at guys who winter calved and weaned young, and they were still getting that benchmark 2.6-ish pounds per day on their steers. So it's not about young, it's about calving later is what you're giving up. But again, the weaning percentage, so if you want to babysit your calves all winter versus the later calving, we're actually weaning a little bit higher percentage of those calves. So Mother Nature was basically running the show. And the wean for live birth was pretty similar. The big difference is this, look at how many pounds. We're running a cow all year, in big 6 versus the other guy 5 more. A ton more labor and a ton more feed for those cows. Not going to say who's making more money. I'm sure both of them right now. Hopefully you're only this market, but who's making more is up for debate. And a lot of these guys, they say, well, they're just my factory for my grass program. Which is fine, but it's that factory. So, just some different things we can do with that data. Pounds weaned per cow exposed, huge variation there, as you can imagine. It's got everybody in there, spring calvers, winter calvers, early weaned calves, late weaned calves. But we had anywhere from 600, like I said, to mostly 300 to 600 pounds. These are the numbers just breaking. I'm not going to get into it too much, but just tweaking some performance data on cows calving the first cycle, average daily gains. You can pick, like I said, $100, $150 a cow in a hurry with very small production changes. So I'm just kind of wrapping up here. Considerations, demand, as I said. Everybody talks about supply. Cattle numbers are getting tighter. They are. We haven't barely even seen them yet. We saw cow slaughter way down, cow slaughter down. Beef cows, 18%, I think, in the U.S. We weren't much different in Canada, dairy cow slaughter. So slaughter has come down, but we still have a lot of beef around. as I said, and there's a lot of cattle on feed. So it's really a demand story more than anything so far. Political uncertainty could trump the market. Had to put that pun in there. Markets tend to peak before we anticipate. If we look at 2014-15 as a prime example, we really had the tightest beef supplies in 2015. The U.S. market peaked in 14. That's when it gets dangerous. Everybody gets revved up. We have that shortage of calves. We keep those heifers back. You buy those calves because everything's going to be glorious and we're going to have less cattle next year. But as soon as we get over that hump of there's more cows coming, there's more heifers being retained. When those heifers are being retained, that's your tightest time for calves. But the market's can already anticipate, you know what, we're going to have more cattle down the line. It might be months away, but they'll start to switch. It's no different than 2022. We had record beef production in 2022. All year long prices went up because they were anticipating this is the peak. We're going to start getting less coming down the line. So same story works both ways. And I'd have to watch if the U.S. gets really good weather this year, puts some heifers, pulls heifers out of the feedlots, puts them out to pasture, starts breeding those heifers. Owning cattle later this year could get the risk escalates quickly. You're buying into a very tight market. And, you're buying basically probably the tightest market. So selling those, and you're going to be buying those anticipating higher prices. And that market, if it doesn't even go higher, you'll lose money. And if it starts to turn lower, you'll lose money faster. So just being careful. But again, the cow-calf guy, it's a seller's market for sure. Screwworm I mentioned, considerations, not expecting a 2016 correction just because the weather doesn't seem to be that favorable in the U.S. for expansion. Looks much slower. Again, cow-calf guy is good. And then how are you investing profits? Had a little interview earlier about that. We watch the grain guys and their shiny equipment and all that kind of thing, maybe a little bit jealously, but there's payments and all sorts of other risks and headaches associated with that. And, I think as cow-calf guys, we still have a different overhead model and cash flow rate than them. So let's invest wisely. Where's your profits? Are you investing in areas to make your operation more profitable and competitive? One of the things we talk about land use. Why is our cow herd shrinking? Well, we're losing this land, our grazing land, or hayland to grazing and hayland to grain farms. Look how much intensity they're managing from seed and fertility and weed control. We just open our gate and turn our cows out, and then we're not making much money on our grassland when its values are getting dragged higher with all the other land. So, there's great programs out there for cross-fencing, water development, ways you can probably double your pasture productivity if you're not doing much today, and species management. So that's the investment that's going to help you long-term. And ways to expand your cow numbers without needing a land-based change. Or in things that will increase over, do that, or better genetics or anything, versus, that shiny equipment increases your overhead costs. Will a herd expand? The feedlot sector sure has. It's expanded incredibly fast. Some large, 50,000 head feedlots been put up in the last few years. They continue to expand, but the cow-calf side has not, as we've shown. We've maybe leveled off here, but I often say the cow-calf sector, we've lost a lot of cows where I'm from and sort of north central Saskatchewan, Alberta. They used to be mixed farms. They're just now grain farms. Our cows used to complement the land, not compete with the grain land. So there's still those opportunity for cow-calf guys if the grain guy's willing to participate, but it's hard sometimes. We also need confidence in these markets and prices sticking around because, a bred heifer's $4,000 or close to, or way more. There's some that are selling much, much higher than that. So you need to have confidence that's going to pay off because you're going to need some good calf prices for a while. Capital, cattle, land, equipment, as I said, if we complement the grain land, there's guys that are, bunch grazing. There's still different aftermath grazing and different things that they can complement grain land. And if you look at the price of feed sometimes, and I was doing some numbers on chaff, can you pay a guy $50 an acre? Would a grain guy mind $50 an acre to put chaff out? It's a struggle sometimes, but those are big enough values now when their margins are squeezed and you have the money to pay for that. of having those discussions. Land at reallocate, and then technology and research. Be pretty cool if those collared cows actually work. You want to go graze some cows on some wasteland. You don't even need to put up a fence. So things like that makes life easier for the cattle guy. So that's my presentation. Pretty much that's an hour. As close I've been. Hoping there's any questions. I've got a few minutes. I'll be around for a little bit, but yeah, any questions on anything here? What am I out to lunch on? Tell me. Oh, yeah. Yeah, no, for sure I do. I did skip over that one a little bit. We do focus on that, but it's here. See 41, 44, 47, that number. So this is the weaning weight as a percent. This is the steers. It's not steers and heifers, so I've just taken the steers. So we're in that 40, 45. Very, very few hit the 50% mark. And I'll be honest, like some of these weights are a little bit subjective. I think there's guys, probably cows are heavier than they said. So if anything, that number's maybe highish, but we're in that 40% range. Yeah. Good question. No, thanks. Two minutes. Well, I'm pretty. It's questions or. Yep. Yeah, good question. Question about a price floor, a new normal, new range. I'm never a big fan of using new normal because, quite often these markets go higher than we think they do, we expect, and then they almost always correct lower, right? But we kind of saw that. We saw that as if you go back, after 2014, 2015 hit. Oh boy, so I got to go all the way to the beginning. My first slide. We see it in all markets. The old highs become the new lows. Canola was a little bit like that. Went to 20, or when it first went to $15. And then before we knew it, we're in this new normal. And then boom, we were back to 10 or 8. The old high used to be $10 canola. Now, then it hit that 15, went sideways for a bit, then it went to 25, and then we're back to that 13, 15 range. If you look at, if you extend this further back, the old highs used to be $1.82, well, rarely $2. The old highs became the new lows. And it holds through in most commodity markets, but that's kind of a scary drop to get back to those old highs, right? Or maybe it's this even I don't think 330 is out of the question at all. If we saw a change in the dollar and feed costs and such. So I think, with inflation and everything else, we're, $2, $2.30 calves, hopefully not. Or if you do, it's a kind of a spike down and you find this range in the middle here. But the reason I say that, we kind of have to be prepared for a bit of a violent correction. This one was rather violent in 2016. I don't think that's, if we could have gone from there to there, we could have lived with that. That would have probably been more normal. But, yeah, I think we're going to have some higher price ranges. But, doesn't mean we're always going to be over $4 calves by any means. We got a 550 weight calves, as I said, $5. $4 doesn't sound too bad, does it? If I would have come here 2 years ago and told you you're going to have $4 calves next time I come back in 2025, you probably would have been happy. But now if I say it'll be $4 calves this fall, I think that might be disappointing for some, and rightfully so. I think there's plenty of support out there, but you can forward sell some calves. It'll be price insurance for calves comes out in like 2 weeks, so have a look. So just some thoughts around that, but yeah, I'd be prepared to see a correction and put some insurance on it. Yep. Just shout it out. Oh. It's always a clear out. Yeah, the question is if prices go back to $3 a pound, in today's marketplace and inflationary, we're going to continue, even if prices stay at $5, we're going to continue to see people exit. It's just not going to be as fun exiting when it's under $3. And we're going to continue to probably see less cows around. This trend is probably not, if you look at the last 50 years, we've got less cows, less producers. I'm not sure that's going to change. This may level out at some point, but $3 calves. Yeah. 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 Well, and that's a good point. You're going to have less producers. The number of producers drops faster than the number of cows. We lost I'd have to be careful what I say, but over a quarter of our producers in a time span, and we only lost like 15% of the cows, kind of thing, for example. But yeah, there'll be a lot more but you can say you can rent your grass. Somebody's going to rent and put cows, some of it will put cows on it. But these trends are kind of here. It's grain, dairy, doesn't matter, supply management. We're still getting less farmers, bigger farmers. Unfortunately, I'm not saying that's good, but it's kind of reality. Nobody's gotten.
So we're going to have to cut that one off. Sorry, there was some good discussion, but we do have our next session starting here right away. So give a round of applause to Brian here for a very informative talk.